Hello, dividend growth stock investors. Happy Sunday to you here on June 15th, 2025. We've got a lot of scary stuff going on in the Middle East right now. What else is new? If you ask me, I mean, it's always something scary going on in that part of the world, but tensions heating up a lot between Israel and Iran. Of course, for us investors, it happens on a Friday, so we're going to be sitting around waiting, here over the weekend to see what this is going to do with the stock market. Listen, guys, war is hell, and there's certainly more important things in the world than money and investing. But this is a investing channel, and it's all about earning passive income. And this is not a political show, so I'll just keep my political opinions to simple as that. War is hell. But for you all out there investing in the markets, don't let war become a distraction. What I mean by that is that when major conflicts are going on in the world, some new escalation takes place. The markets react. Of course they do. And there's generally a certain amount of panic, and it seems as though there's a even more speculating that ends up happening, where people are kind of guessing what industries and what individual companies might be a beneficiary of this conflict versus the ones that are going to really be in trouble as a result of it. And personally, I don't really like to go down that road, that line of thinking, because at the end of the day, even if your reasoning and your research is sound, it's all still just sort of speculating as far as that goes, because we don't know how long any particular conflict is going to go on, what the magnitude of it's going to be. Is it something that's going to cause a ripple in the market for a few days or a week? Or is it something that'll have longer lasting impacts for months or even a few years? We just don't know, you guys. So, that being said, I am going to be just sticking to my plan regardless of what is going on around the world in terms of wars and conflicts and any other thing that might actually happen. Now, I'm not a professional financial advisor, so don't take any of this as direct financial advice. This is for entertainment primarily, and these ideas are just my own, so do your own due diligence. But my aforementioned strategy is the same as it's always been here, you guys. I'm going to put 50% of new money each and every week into age appropriate ETFs. And I'm going to be looking for stocks yielding 30% or more above their 4-year average yield. That's my main emphasis when buying. But the primary emphasis, of course, is my age and time horizon. So I've got a top 10 favorite group of stocks where if they're yielding 20% or more above their 4-year average yield, I'm not worried about my age or my time horizon. I just buy them at that point in time. And then as for the rest of it, though, this channel only focuses on 60 individual dividend growth stocks split into 4 separate categories or tiers based on your age and timeline. So I'm typically going to remain within my tier, the only exception being if there happens to be a stock in a different age tier, meaning it's just maybe not one that's typically most appropriate for my personal age and time horizon. If that yield is 50% or more above the 4-year average yield, I will dip down or dip up into a different tier and add a little bit of money to that stock. It won't be a priority. I'm still going to stick to my tier for the most part, but I could put a little money here, a little money there into some other things if they look way underpriced. And if I don't see anything that looks viable by my own metrics in any given week, I will still invest what I plan to invest as far as dollars are concerned. I'll just hit the ETFs harder. So that way I've got a portfolio that is going to have probably more than a 50% allocation into ETFs, but 50% would be my minimum as far as the ETFs go. So, all right, you guys, you know the drill. If you are a regular viewer here of the channel, we're going to go into the spreadsheet, look at each of the 4 age tiers. So why I put this together this way, you guys, is for one, I wanted to make sure that if somebody is putting together a similar plan for themselves, you don't have to follow mine to the letter, but the main idea or emphasis I think should be the same, where if you're in this 30 or younger age bracket, you're not really trying to accumulate really high yield when you're starting out. You probably don't have enough capital to invest to put together a significant amount of dividends when you're young anyway, so just Put your stuff into stuff that has low yield, but very high yield growth. We want to get like 1 to 2% yield for the most part, but we want to comfortably above 10% annual year over year dividend growth rate. All those decades in the market, you're going to see that double digit dividend growth rate compound your passive income really quickly. It does take time, but if you're young, you've got time. So just be patient there, you guys. So I've got these sorted out here by the valuation tab, where I've compared the 4-year average yield, which I update every single week before I do the video, and I'm comparing it to the current day yield to see how far off it is. So United Health is still in that number one spot right now. They have slightly recovered a little bit. They were down a little bit below $300 at one point. Still way down here in the dumps, though, yielding more than twice as much as the 4-year average yield at 2.82%. So for my money, this is perfectly acceptable to invest in, almost regardless of what age tier you're in, because United Health, I think, is going to recover. See, I'm a lot more comfortable with the long history, track record, market cap, growth rates, etc., that these blue chip stocks have demonstrated over the years than I am speculating on how this Middle Eastern conflict is going to impact any of these individual companies. That's where I'm going. I think that's a more predictable metric. Now, my batting average isn't always going to be 1,000. Also, I'm not always right. Nobody ever is, but it's certainly going to be better than average because I'm just not speculating on weak speculative companies. Nike, still way down. 4-year average yield keeps ticking up a basis point or so each and every week. It's climbed up to 1.33% on the 4-year average yield, but that is still, way off the current day yield of 2.64%. I'm not expecting a 10% dividend increase from Nike this year. It's probably going to be a little bit lower, but I am getting a much higher starting yield than I would have gotten at any point over the last decade. So stay in the course there with Nike. Nordson, this one was all the way down into the $180 a share range over the last 4 to 6 weeks. It has recovered nicely. Still looks like a nice overall value because our 4-year average yield on that one is 1.02%. Currently yielding 1.46%. I like it at those prices. And Lowe's, getting close to being in my buy zone, but I'm still going to wait a little bit more on Lowe's. They've given me a couple of crummy dividend increases over the last couple of years. It is what it is. That's why we've got a group of 10 plus stocks in each of the tiers, because you'll have a couple that'll disappoint, couple that'll overachieve, and the end result is you want that average growth rate in this group to be above 10%. So let's move on to tier 2, you guys. This is age 31 to 41. Our starting yield in this category is going to be like 2.5 to 3.5% for the most part. We're looking for annual dividend growth in the 7 to 9% range on these stocks as a group. We've definitely had some continued recovery from tier 2, where we've had 5 and 6, different stocks at any given time in this tier that have hit the buy zone. Our 2 standard fare dogs here of late, Target and Hershey, are still in that zone, but Hershey's recovered enough. At least they've gotten back below that 50% undervalued mark. I'm hoping Hershey could start to be on the upswing now. As I said last week, this has become a top 5 holding for me in terms of just the individual company stocks, because I've just been hitting this one hard for like the last 6 months or so. Happy to continue to do it. With that yield being 3.24%, 4-year average just 2.19, I'm there all day for Hershey. Target, as I've been saying, I think their dividend growth may be slowing down over the next few years, just a guess. But that current day yield of 4.7% is wild. This is a dividend king. I don't think that their dividend is in any danger right now as far as them just having the money to cover it. So, if you're still buying Target, I'm still adding Target right now and enjoying the high yield that I'm getting out of the deal. Tier 3, age 42 to 53-year-olds, starting yield in this group is going to start to creep up a little higher. We're now looking for at least 3%, but up into the 4s sometimes as well. Dividend growth won't be quite as quick with this group of stocks as in tier 2. We're probably looking at like 5 to 7% here out of these guys. It was a little bit of a down year last year. They fell just short of 5% as a group in 2024. This is where we've got the most value this week. We've got four stocks that are in that buy zone, including Pepsi, which is not only the top undervalued stock in this tier, but it is one of my top 10 favorite stocks. It's on that list for me. So this one only has to be 20% off the 4-year average for me to want to add to it. And it's 52% off. So I'm definitely still hitting Pepsi really hard, getting 4.35% starting yield for my money at these prices. Let's go. Archer Daniels Midland, same thing, yielding just shy of 4% right now. They've started to recover a little bit. We'll see how things go with them, but I still like this dividend king, yielding just shy of 4%. Hormel and Genuine Parts Company are still in that buy zone. Hormel, the longer it stays down and the more that 4-year average yield ticks up, it's starting to threaten to go out of the buy zone as this high 3% starting yield is starting to look more like the norm than the aberration. And if that's the case, then that's going to be the point where we pump the brakes, because the longer it stays down, then maybe that's going to be reason to slow down and stop adding as much to that position at any given time. And then T. Rowe Price, man, T. Rowe Price just cannot get out of the basement. I really would like to start adding some T. Rowe Price, but I'm still not quite old enough. I haven't hit age 42 just yet, and they are not undervalued enough for me to want to go add them. But man, a 5.5% yield. I really like T. Rowe Price, but man, the market hasn't liked them for a couple of years. So that 4-year average yield has climbed to almost 4.5%. Tier 4, age 54 and older investors. I have yet to find a good value in this tier, you guys. It's the smallest group of stocks of the tier. I only found 10 that had good high yield, but good enough dividend growth to make them worth investing in individually. We're trying to get like 5% at least out of this group, if not a lot more. Still want to get like 2 to 4% dividend increases to keep up with normal years of inflation, but there's just not a buyable individual stock in this category for me right now, you guys. So we're going to do ETF double down again if you're in that 54 and older crowd, because why not just load up on higher yielding ETFs? Just a quick swing by, guys. This is my top 10 favorite group of stocks. All of these are located somewhere between tiers 1, 2, or 3. So just have them here on a separate tab. If you want to pause and just look at them real quick, these are my top 10 favorite stocks. I want to have big positions in all of these by the time I hit financial freedom. And then, guys, here we're going to talk strategy just to wrap things up. So this is how I would handle things depending on what my age and time horizon was. Now, I'm personally in tier 2. But I'm going to start here at tier 1. So I'd put 25% of my money into the S&P 500, 15% into a small cap value, 5% I'd put into VIG for dividend growth, and 5% into VYMI for high yield international exposure. Tier 2, it's going to be those same 4, different allocation, where VIG gets the 25%, the S&P 500 gets the 15%, the small cap gets 5%. Tier 3, SCHD, VYM, DHS, my 3 favorites for this particular category. You could just do one of them, or you could get a little of all 3. I'm probably, when I hit 42, I'm going to start doing a little bit into all 3, and I think SCHD is going to get the bulk of it, but nothing against VYM or DHS. They're all excellent for me. Just going to warn you guys, there could be a shakeup here in Tier 4. I had a very interesting conversation with Jeremy over at Dividend Stockpile about some ETFs that he really likes that are higher yielding. It might be time for me to update my Tier 4. You're going to see that video here later in the week when I get done editing it. Really excited to show that one to you guys. But Tier 4, going to get some exposure to stocks with SPYD, high yield stuff in the S&P 500. And I'm going to hit bonds, preferred shares, MLPs, some covered call ETFs, and some international. And then here would be how I'd break it down for the single stocks. For Tier 1, UNH, Nike, and Nordson are my first priorities, along with Pepsi. And then maybe Target and ADM if I had a little bit left over. For Tier 2, the priorities would be Target, Hershey, Pepsi. Maybe then dip down into Tier 1 for UNH and Nike, up into Tier 3 for ADM. Tier 3, of course, Pepsi is going to get hit the hardest, but then ADM, Hormel, GPC, and then Target, UNH, and Nike after that. And I would throw a little bit into Pepsi in that Tier 4 category as well. It is my favorite deal of all of the stocks. of that group of 60. I think that one's can't miss at these prices. You just got to be willing to hold it for the long haul. And that's the video, guys. War is hell. See you next week.